Hello and welcome to the Microlearning Institute. In this short tutorial we plan to introduce the fundamental principles of IAS 36 Impairment. IAS 36 Impairment applies to land and buildings, machinery and equipment, investment property carried at cost, intangible assets including goodwill, investments in subsidiaries, associates and joint ventures carried at cost, and assets carried at revalued amounts under IAS 16 and IAS 38. IAS 36 impairment does not apply to inventories, which are held under IAS 2. It does not apply to assets arising from construction contracts, which are held under IAS 11. Does not apply to deferred tax assets, which are held under IAS 12. Does not apply to assets arising from employee benefits, which are dealt with under IAS 19. Does not apply to financial assets, which are held under IFRS 9. Neither does it apply to investment properties carried at fair value, which are dealt with under IAS 40, or to agricultural assets carried at fair value, which are handled under IAS 41, or to insurance contract assets, which are held under IFRS 4, and neither to non-current assets held for sale, which are held under IFRS 5. The fundamental objective of IAS 36 is to ensure that assets are carried at no more than their recoverable amount. IAS 36 defines how recoverable amount is determined. An asset is said to be impaired when its carrying amount on the balance sheet exceeds its recoverable amount. The carrying amount of an asset is the amount at which an asset is recognized in the balance sheet after deducting accumulated depreciation and accumulated impairment losses. IAS 36 defines the recoverable amount of an asset as the higher of an asset's fair value less cost to sell and its value and use. That fair value of an asset is the amount obtainable from the sale of an asset in an arm's length transaction between knowledgeable, willing parties. The value in use of an asset is the discounted present value of the future cash flows expected to arise from 1. The continuing use of the asset, and 2. Its disposal at the end of its useful life. IAS 36 requires that at each balance sheet date we review all assets to look for any indication that an asset may be impaired. IAS 36 defines the recoverable amount as the higher of the fair value less cost to sell and the value in use. To determine the fair value less cost to sell, we look to see if there is a binding sale agreement, and we use the price under that agreement less any cost of disposal. Alternatively, if there is an active market for that type of asset, we use the market price less any cost of disposal. Or if there is no active market, we use the best estimate of the asset's selling price less any cost of disposal. The calculation of the value in use of an asset should reflect the following elements. 1. An estimate of the future cash flows the entity expects to derive from the asset. 2. Any expectations about possible variations in the amount and timing of those future cash flows. 3. The time value of money, represented by the current market risk-free rate of interest. And 4. The price for bearing the uncertainty inherent in the asset. When calculating the value in use, any cash flow projections should relate to the asset in its current condition. Any future restructurings to which the entity is not committed and expenditures to improve or enhance the asset's performance should not be anticipated in the calculation of value in use. Also, when calculating value in use, estimates of any future cash flows should not include cash inflows or outflows from financing activities or from income tax receipts or payments. Also, in measuring the value in use, the discount rate used should be the pre-tax rate that reflects current market assessments of the time value of money and the risks specific to the asset. To determine the discount rate, the following would normally be considered. 1. The entity's own weighted average cost of capital. 2. The entity's incremental borrowing rate. And 3. Other market borrowing rates. An impairment loss should be recognised whenever the recoverable amount is below the carrying amount. The impairment loss is an expense in the income statement, unless it relates to a revalued asset where the value changes are recognised directly in equity. Following recognition of an impairment loss, we adjust depreciation for future periods. Impairment of the recoverable amount should be determined for the individual asset if possible. However, if it is not possible to determine the recoverable amount for the individual asset, then we determine the recoverable amount for the asset's cash-generating unit. A cash-generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or groups of assets. A cash-generating unit to which goodwill has been allocated shall be tested for impairment at least annually by comparing the carrying amount of the unit, including the goodwill, with the recoverable amount of the unit. Goodwill should be tested for impairment annually. To test for impairment, goodwill must be allocated to each of the acquirer's cash-generating units or groups of cash-generating units that are expected to benefit from the synergies of the combination, irrespective of whether other assets or liabilities of the acquiree are assigned to those units or groups of units. If the recoverable amount of the unit exceeds the carrying amount of the unit and the goodwill allocated to that unit is not impaired. However, if the carrying amount of the unit exceeds the recoverable amount of the unit, the entity must recognise an impairment loss. Any impairment loss to a cash-generating unit is allocated to reduce the carrying amount of the assets of the unit in the following order. First, reduce the carrying amount of any goodwill allocated to the cash-generating unit, and then reduce the carrying amounts of the other assets of the unit on a pro rata basis. The carrying amount of any asset should not be reduced below the highest of 1. Its fair value less cost to sell, 2. Its value in use, and 3. 0. IAS 36 also advises on the reversal of an impairment loss. Here we take the same approach as for the identification of impaired assets. We assess at each balance sheet whether there is an indication that an impairment loss may have decreased, and if so, we calculate the recoverable amount. There's no impairment reversal for the unwinding of a discount. Also, the increased carrying amount due to reversal of an impairment should not be more than what the depreciated historical cost would have been if the impairment had not been recognised. The reversal of an impairment loss is recognised as income in the income statement. And following the reversal of an impairment loss, we adjust depreciation for future periods. Note that the reversal of an impairment loss for goodwill is prohibited. Thank you for visiting the Microlearning Institute and for watching this short overview of IAS 36 Impairment.